Hey everyone, it's Friday, December 6th. Wall Street just wrapped up another week, so we're here to break down the biggest market movers. And we're going to be looking at all this through the lens of what matters most to you, the retail investor. I think this is you know, your cheat sheet for staying ahead of the curve. Our source today is an insightful analysis from Market Deep Dive. They're known for cutting through all the noise and giving us those clear, actionable insights that we love. And get this, even though most sectors actually dipped this week, two major indexes actually climbed. The S&P 500 even hit a record high. So how is that even possible?
Well, it really shows you the power of the tech sector, those tech giants. I mean, they have such huge market caps. And it's not just the usual suspects like Apple and Microsoft either. We saw a surge across the entire tech landscape, from chip makers to software companies. This tells us something really interesting about investor sentiment. There's definitely a risk-on vibe in the air.
Okay, risk on. What does that actually mean for someone like me, managing my own portfolio?
Well, it means investors are feeling bold. They're willing to bet on higher growth companies, even if it means accepting more volatility. They're moving away from those safe haven sectors, like utilities and real estate, which tend to perform well in uncertain times, but offer limited growth potential.
Okay, so maybe time to swap out those comfy slippers for some running shoes, embrace a little more risk.
Well, that's one way to look at it, but it's really crucial to align your investment strategy with your personal risk tolerance. If you're someone who loses sleep over every market dip, chasing high-growth tech stocks might not be the best fit. This risk-on environment could be an opportunity, but it's also a time to be discerning.
Solid advice. Speaking of opportunities and uncertainties, let's unpack this week's jobs report. It seems like everyone's got a different take on what it all means.
Yeah, it's definitely a mixed bag, full of seemingly contradictory data points. On the surface, the November jobs report looks pretty rosy. We saw a robust rebound in job growth, blowing past expectations with 227,000 new jobs added.
Sounds promising. More jobs usually equals a healthier economy, right? But I have a feeling there's a but coming.
There is. While that headline number is impressive, the unemployment rate actually ticked up slightly to 4.2%. And here's the real head-scratcher, the household survey, which is another way to gauge employment, actually showed job losses last month, a significant drop of 355,000 jobs.
Wait, so which is it? More jobs or fewer jobs? It's like getting two different weather forecasts for the same day.
It's a legitimate question. Remember, these surveys capture different aspects of the job market. The establishment survey, which gives us that main jobs number, is based on a larger sample size, and it tends to be more stable. The household survey, on the other hand, can be more volatile and subject to bigger swings.
So it's like trying to measure the ocean's temperature with a single thermometer versus a whole network of buoys.
Exactly. Plus, you have to consider external factors that could be skewing the data. Think about the recent hurricanes and those major worker strikes we saw. Those events can temporarily disrupt businesses and lead to job losses, which might be reflected more strongly in the household survey.
Okay, so we have this puzzle of a jobs report, but it seems like the market is choosing to focus on the positive, at least for now. There's a lot of buzz about a potential rate cut on the horizon.
You're right. The market seems to be pricing in a rate cut by the Federal Reserve later this month. We saw the 10-year Treasury note yield drop to a 6-week low, which is often a telltale sign that investors are anticipating lower interest rates.
So how much weight should we give to this dip in bond yields? Is it a surefire sign that a rate cut is coming? And if so, what are the ripple effects, especially for us everyday investors?
Well, while a significant drop in bond yields is a strong indicator, it's not a guarantee that the Fed will actually cut rates. They consider a whole range of economic data, not just what the bond market is doing. But it does suggest that the market is increasingly confident about a rate cut. As for the impact, it really depends on which sector you're looking at.
Let's get specific then. What should retail investors, our listeners, be paying close attention to? What sectors could benefit? And which ones might take a hit?
Well, a rate cut could be a boon for sectors like real estate and consumer discretionary. Think about it. Lower interest rates make it easier and cheaper for people to borrow money for big purchases like homes and cars. On the flip side, sectors like financials could feel the pinch. As their profit margins shrink with lower interest rates, their lending business might not be as lucrative.
So it's a classic case of winners and losers, depending on how the interest rate winds blow. Now let's shift gears and talk about some individual companies that caught our eye this week, especially in the retail and tech space. We saw some interesting earnings reports that defy the odds.
Absolutely. Ulta Beauty and Lululemon both managed to exceed earnings expectations. which is quite remarkable considering the headwinds facing their respective
Where's
sectors.
the beauty with all those makeup and skincare goodies?
Hmm.
And Lululemon, known for their comfy yet stylish workout gear. So what's their secret sauce? How are they thriving when others are struggling?
It seems like both companies are adept at navigating the ever-changing retail landscape. Ulta Beauty is doubling down on personalized experiences and loyalty programs to draw in customers, while Lululemon is expanding its product lines and targeting new demographics.
Smart moves. They're not just riding the wave, they're actively shaping it. And speaking of industry giants, we've got some big earnings reports coming up next week from Broadcom and Oracle, two heavyweights in the tech world. What should we be watching for?
These reports could offer valuable insights into the overall health of the tech sector. Broadcom is a major player in semiconductors, those tiny chips that power everything these days. And Oracle is a leader in cloud computing and enterprise software, essential tools for businesses of all sizes. Their results will be closely scrutinized for signs of continued growth or any hints of a potential slowdown.
Right, because what happens with these titans can send ripples throughout the entire market. Anything specific retail investors should be paying attention to.
I'd say keep an ear out for any commentary from these companies on their outlook for the coming year. Are they optimistic about continued growth, or are they starting to see some storm clouds on the horizon? That kind of forward-looking guidance can be incredibly valuable for investors trying to make smart decisions.
Great point.
So we were just talking about some of those big tech earnings reports that are coming up next week. But there's another major event on the horizon that could really shake things up, and that's the release of some key inflation data. We'll be getting both the Consumer Price Index, the CPI, and the Producer Price Index, the PPI.
Yeah, you can't turn on the news these days without hearing about inflation, and for good reason. It impacts everyone, from the everyday shopper to the seasoned investor. It erodes the value of our savings, makes it harder for businesses to plan ahead, and it can really rattle the markets.
Yeah, inflation has definitely been the buzzword of the year, maybe even the decade. Early forecasts suggest that inflation might not be fading as quickly as some had hoped. The consensus estimates for CPI are showing a similar level of growth to what we saw in October, which could be a signal that inflation is becoming more persistent, more entrenched in the economy.
Uh-oh, that doesn't sound too encouraging. And how does this all tie into the Fed's big decision on interest rates, the one we were speculating about earlier?
This is where things get really interesting. The Fed has been raising interest rates as their main weapon in the fight against inflation. But if inflation isn't coming down as quickly as they'd like, it could force them to make some tough choices. Either raise rates more aggressively or keep them higher for longer.
So it's like a high-stakes balancing act for the Fed. They're trying to tame inflation without pushing the economy into a recession. Talk about pressure.
Exactly. It's a delicate dance. And these upcoming inflation reports will be crucial in their decision-making. They'll be looking for any hints that inflation is starting to ease. Or, conversely, any signs that it's becoming even more widespread and stubborn.
Okay, so what are the key things you'll be watching for in these reports? The clues that could tip the Fed's hand one way or the other? And ultimately, what does it all mean for us regular investors?
The most important figure I'll be focusing on is the core CPI. This strips out volatile food and energy prices, which can jump around a lot, and it gives us a clearer picture of underlying inflation trends. If core CPI comes in hotter than expected, it could increase the chances of the Fed getting more aggressive with rate hikes.
Okay, so that's core CPI. Anything else on your radar?
I'll also be watching for any signs that inflation is broadening out, spreading beyond just a few sectors. For example, if we start to see significant price increases in things like healthcare or education, that could be a red flag that inflation is becoming more pervasive and harder to control.
Got it. Broader inflation equals more headaches for the Fed, and potentially for our wallets too. So let's break it down for our listeners. What does a more aggressive Fed mean for their investments?
Well, it could translate to a few things. First, we might see continued volatility in the stock market as investors react to the uncertainty surrounding interest rates. Second, we could see interest rates on loans climb higher, making it more expensive to buy a house or a car. And finally, if the economy does slow down as a result of those higher rates, it could impact corporate earnings, potentially leading to lower stock prices.
So not exactly a walk in the park. It sounds like we're in for a bumpy ride, at least in the short term. But hey, that's the nature of the market, right?
Yeah.
Always keeping us on our toes. Thanks for breaking it all down, though.
My pleasure. It's all about staying informed and understanding the forces at play.
Couldn't agree more. Okay, let's take a minute to recap what we've learned. In this whirlwind tour of the week's market action, we saw tech stocks flexing their muscles, pushing the major indexes higher, while other sectors lagged behind. The jobs report gave us a mixed bag of signals, with strong job growth on one hand, but a slight uptick in unemployment on the other. And then there's that looming inflation data, set to drop next week, which could make or break the Fed's decision on interest rates.
Phew. It's been a week full of twists and turns, that's for sure. But remember, knowledge is power. The more you understand about the market and the factors influencing it, the better prepared you'll be to make smart decisions for your own financial well-being.
Well, that's all the time we have for today's deep dive. We hope you found it insightful, maybe even a little bit entertaining. Remember, knowledge is your most valuable asset, especially in the world of investing. So keep learning, keep exploring, and keep diving deep. We'll be back next week with a brand new episode. Until then, happy investing.